Thank you everyone for joining us on a Saturday morning. We would like to just give you an overview of why we chose this particular topic for today, which is multi-asset investing, a winning strategy across market cycles. What we noticed is that the environment in which we're making investment decisions is changing quite rapidly. And at the same time, you have this thing of uh, investor preference is also changing a lot very quickly, right? And so there is this need to have a solution that works at any point in time for everybody. And at some level, that might seem too much to ask for, but is it really? Because if we look at some of the well researched areas of finance, and if we look at some of the well executed solutions, investment solutions for investors, you'd realize that actually there is a way to address this changing environment and the changing preferences also of investors. And that is where multi-asset investing really works in favor of investors, in favor of performance. And that's something that we're going to break down in the next 1 hour with you. So we'll try to keep our presentation short, and we'll keep the floor open for questions towards the end. You can type in your questions in the chat box and we'll get to it after we finish our presentation. You can also type it into the Q&A wherever whatever your preference is, you can use each of these options. We're also going to be running a couple of polls through the webinar, and we request all of you to participate because each person's voice really matters in what we're discussing today. And we'd like to hear all of you, listen to your thoughts, address what questions are there on your mind. So without further ado, please let me begin today's presentation. And I'm going to start off with looking at how we actually make investment decisions, right? I think it's very natural for us as investors to look for a little bit of performance before we're confident enough to actually make a choice, right? So typically we start entering once there's proof in the performance, right? So if you see a particular asset class give you decent returns, as those returns are consistently delivered, we become more and more confident that we're making the safe and the right choice. But what tends to happen is that performance in any asset class is non-linear, which means if you have 2, 3 years of really good performance, it's very, very unlikely that the fourth year is going to be good. And most of us as investors are tuned to look at 1 year, 3 year, 5 year performance. And this is what leads us into this sort of trap where you're buying at the wrong time, you're selling at the wrong time, and your outcomes are actually less optimal. So how do we address this dilemma that investors have? That what is the right time to buy something, uh, given that they have other priorities also to balance, right? You, as an investor, you want to save regularly or you want to save every month. You want to make sure that whatever choices you're making, right, uh, avoid losses. The main reason that investors go into performing asset classes is because there is some comfort that they're not going to make losses. At the same time, you want to compound at a regular pace. You want to make sure that that journey is smooth rather than lumpy, and you want to invest at the right time. This is why so many investors come to us saying that, okay, this week the market is high. Should I wait? This month the market is high. Should I wait? Or, I want to wait for the market to correct before I put in a large amount of money. And you want to make sure that you're investing at the right places. So, how do we actually solve this dilemma? Because there are so many moving parts and so many elements that require each person to pay attention to before you make a decision. So there is one smart and simple way for us to solve this dilemma, and it boils down to two words, which is asset allocation, right? That's all it takes. So how are we going to break down this asset allocation and what does it actually mean? So when we look at some of the prominent studies in financial markets, you will know that one of the popular studies is the BHB determinants, which says that, okay, if we take two different portfolios and we look at what is causing their performance to vary, right? why are returns in portfolio A and portfolio B varying? A lot of us think that it has to do with when decisions were made, that is timing the market, or it has to do with what we bought, which is security selection, right? So maybe if I bought stock A instead of stock B, maybe that's why portfolio A performed better than portfolio B, right? But what this study actually showed us was something very interesting, that it's really, of course, those things do make a difference. It's not that they don't, but over 90% of return variability boils down to asset allocation. It's not about which stock you own or which bond you own. It's about whether you own stocks or bonds at the right point in time, right? So this is 90%, and this is where our focus just seems to waver. We don't pay any attention to asset allocation. Instead, we put a lot of time and effort into, is this the right time to buy? The Nifty is at this level. Should I look at equity, or should I wait for the index to correct 2%, right? So timing the market accounts for less than 2% of return variability. But that's where maybe 70 to 80% of our effort goes in, right? As opposed to putting that effort into asset allocation, which causes 90% of the variation in returns. So this is one of the key lessons that we picked up. The next key lesson is that a lot of investors will come to us outside of their risk profile saying that, oh, I've seen the last 10, 20, 30-year returns in the Sensex or the Nifty, and I know that for a long-term investor, that equity is the way to go, right? And more, of course, equity is a great asset class, and every investor should participate according to their risk profile within this. But what happens when nothing happens? Which is that you can have years, maybe 5, 6 years, where there are almost zero returns if you park your money in equities. So if you have a question, you can just type it in the chat box. We'll take it towards the end. Thank you. So if you have no returns through this entire period, right? Most investors lose confidence, and this can happen in any asset class. It can happen in domestic equities, it can happen in global equities, it can happen even in an asset class like gold, right? And these, uh, when you don't see any performance, investors lose confidence and they move out. But performance comes after underperformance, right? That's how cycles work. You have your ups, you have your downs. So if you've got a good period of performance, you're eventually going to enter into a lull. And then over a period of time, that lull is going to become another re-entry opportunity. So it's, as we head into the summer, like we can think about certain frameworks, which is how do we actually do a temperature check on markets, right? And ICSA has a great framework where if you look at what they do, they have this heat map, which shows us that, okay, and they have a bunch of different factors that they put into this graph that you see. And depending on where that, at what point in time you're looking at it, you can see whether you're in the zone where you need to book profits out of equity and look at other asset class options, or you have zones where you can add into fixed income. You have zones where you can just be neutral, meaning you don't really know where the next opportunity is going to come from. And then you have zones where it's a clear call to sort of transfer your asset allocation or reorient it more towards equity. So now that you know what zone you should be buying, can you actually come up with a winning solution for all markets, right? And if we just look at three elements here, which is your equity, your gold, and your fixed income, you will see that the winner keeps changing. You don't really have more than 3 years where the winner is the same asset class, right? Uh, so your winners keep changing, your losers keep changing, and but what kind of remains constant is your multi-asset. Like you're never going to come out on top, but you're also never really at the bottom. And if you look at the returns, these are fairly comparable to equity. You're not doing much worse than equity. You do better than equity in the years that equity is down, and you do less than equity in the years that equity is kind of on the top. So this kind of gave us this insight that this is what actually can work for a wide variety of investors over a long period of time. And it solves this question of where to participate, when to participate, how to participate. It solves this question of if I want to save regularly and I don't want to um, sort of worry about is this the right time for me to make an investment, you have this multi-asset investing style that really works. And lastly, you don't have to worry about performance, because often what investors fear is that if I take a lower risk approach, am I also settling for lower returns? And that's not a very pleasant choice to make as a young aspiring investor, right? If you have higher wealth creation targets, you don't want to compromise on that return metric. So this solution kind of perfectly marries all of the elements of that dilemma that we were talking about earlier. So why does asset allocation work? Because this is, I've just shown you a little bit of data, and does that actually give you confidence to make this investment choice or this style choice in the way you're going to manage your wealth? So let's do this through a case study. And I'd like all of y'all to help Aksha make some investment choices. Okay, let's rewind a few years. Imagine that it's 2018 and Aksha wants to save money every month. She's looking at investing with a 5 to 6 year horizon, say 2018 to 2023, and she wants to avoid losses. She's a conservative investor. She doesn't want to have investments that are constantly drawing down, and she wants to participate in winning asset classes. So, how can we help her make an effective investment choice? Now, to make this a little bit easier, instead of just giving you a few options, I'm actually going to show you what that performance was like in the last couple of years, right? So, these are the return numbers for these asset classes in 2022 and 2023. Okay, I want you to take a good look at these numbers, and I'm going to launch a poll here. And you tell me where Aksha should actually make her investment choice, right? Should she invest in gold? Should she invest in credit risk? Should she invest in global? Uh, or should she invest in small caps, right? So what is it that Aksha actually needs to do today? You can just type your answers in the chat box.
Sam, I've disabled the chat. I'll enable it right now.
Can you enable it? Because I launched the
Yeah, I
poll,
will
but I'm
enable.
not able to see it here.
Yeah, I will enable it.
Sorry for that confusion. Yeah, I think I've launched the poll, so can you all see the poll?
Yeah, it's visible.
Great. So y'all can just type in, I think the poll should show on your screen. I think we've got about 12 votes, but we have about 40 people here. So I'll just wait until we have a few more. Y'all can just type it into the poll itself. That way we can see everybody's results visually in front of us. I really like Mr. Vineet's response because I feel then our message is getting conveyed. Okay, So a lot of responses for gold. I think nearly half of us have actually voted for gold. Some for credit risk, some for global, one for multi-asset. Good, good response. So again, I think gold is showing us recency bias, right? This is a week where gold has been in the news for a really long, for a lot of reasons. Like you've had four consecutive sessions of new record highs. Gold has crossed that mark of $2,300 per ounce. And I think that's an important thing to keep in mind, but this performance didn't come overnight. Like we've seen gold rise, and you'll see this because I'm going to show you the returns for the last 6 years, right? So from 2018 to 2013, if you just look at where gold has been, more or less, you've had 8%, 21%, 28%, -3%, then 11%, 12%. So gold has actually been a great performer in this 5 year period. But what's going to actually surprise you is that it's not the top performer. And I'm going to show you what the top performers were, right? So global investments or your international did better than gold by almost 2 to 3%, right? And then you had gold, which was your second best investment for that period. And then you had large cap, small cap, etc. So if I had done this and we had done this presentation or something similar to this a couple of months back, and mostly the response that we got at that point was small cap, right? Because then small cap was all the rage a couple of months ago. So with this, I'm going to actually hand over to Harshil. And Harshil, do you want to take over?
Yeah.
So I think we have the next poll.
So does your answer change? So you can type it after you saw the returns coming in and with most of your replies. Does your answer actually go out and change? No. Okay. Yes. Okay. Yeah. So we've gotten a lot of no's. So your answer is not going to change. There's also a comment saying no because I'm there for 20, 30 years. Yeah, you're there for 20, 30 years. Sure. So you can go ahead and continue doing your choices. There is also a comment saying, but there was a choice or option to choose multi-asset also in the poll. Uh, but I think that anyways, uh, as you go forward, you will again see multi-asset coming in. So I think at that point in time, again, you can go out and choose multi-asset. Right. So I think we can go forward. So a lot of you have said no. So now you look at the quilt. Right, we showed you from 18 all the way till 23 as to who's coming out on top. It was global, it was gold after that, and then large caps were on top. Small caps did not do that bad. But if you look at from 2018 back, what is actually doing well for you? What is actually doing well is between 2010, 11, those 3 years, gold did well. But after that, you saw debt also do extremely well. You see credit risk, you see corporate bonds, you see G-Secs do extremely well. Right. So again, if I were to ask you, is your answer going to change again? Again, by seeing this whole chart, you would say that yes, I think my answer would change because there are years where debt has done extremely well. There are years where gold has done extremely well. Again, because of volatility going up, you see international and mid-cap funds do extremely well. Right. So this is what multi-asset is all about because your winners are always going to keep changing, and your answer is always going to keep changing. Right. Now the whole point of having this sort of multi-asset vehicle is to be at the right place at the right time. Right? So the whole point of multi-asset is that you can win across all cycles. This is a winning strategy across all cycles because here you're able to take advantage of any asset class given that particular market context. Right? That this has nothing to do with for 1 year I will do this and the next year I will go out and start doing that. No, it becomes very difficult for you to look at that. Right? There is a comment that said, yes, I will look for maximum returns. Yeah, this is what most investors do. They always try to go for maximum returns. And do you know what happens when you go out for maximum returns? This is what happens when you go out for maximum returns. Right? So studies have shown that as an investor's effort, where too much effort goes into outguessing, what the market is going to do, what the market is going to do, you're going to keep jumping asset classes, and that ultimately is going to result in you losing out on those particular returns because you're not letting the asset completely yield whatever it is supposed to yield to you. At the same time, you're showing bad behavior because you're shifting from one asset class to the other asset class. Right. So when we are trying to build portfolios here, we understand this trait, right? Because it's important for us to know how behavior plays an impact on investing. So when we create portfolios in Sphere, and because Sphere portfolios are made based on opportunities. So let's say if an investor comes in today, their portfolio will be completely different from somebody who came in 6 months back. Right? Because the opportunity 6 or 8 months back would have been different. So the asset allocation itself would look different. Second, position sizing amongst the businesses that we want to buy keep changing because things are completely different, right? So we understand that it's very difficult to jump between asset classes, but it is important to be there in all these asset classes and make sure that you are positioned well in each of these particular cycles. Like for example, in this particular cycle, what we are trying to do is now we are trying to add more debt. Right. Today, yields are very, it's giving an extremely good opportunities for investors to invest it on the debt side. So for investors who are coming in on the Sphere side, we are able to take advantage on debt, and precious metals for us has played out extremely well. So precious metals again continue to be a very big opportunity for us apart from traditional equity, right? Most PMSs, most mutual funds, most flexi cap funds, everybody would have equity, and their mandate is to have equity. Our mandate is not to have a particular level of equity. We can go from 0 to 100 in any particular asset class, right? We can go from 0 to 100 in equity, we can go from 0 to 100 in debt, we can go to from 0 to 100 in precious metals, we can go 0 to 100 in global also, right? So for Sphere we have no particular cap, and this works for us because we can go out and start taking overweight positions when the market cannot. Right. And the beauty of taking overweight positions when the market cannot is that one, you make the most of it when equity does extremely well because you overweight on equity. Second, when other asset class start to do well, you're again overweight on the other asset classes where equity does not perform. So you're well protected then also. At the same time, that is again giving you an opportunity for us to invest for you in that asset class will yield for you to invest in other asset class. Like let's say, for example, debt does extremely well and equity does not. Debt gives us an opportunity for us to take advantage of building positions on the equity side. Right. So how do you make the most of all asset classes? Right. This is what Sphere does when it tries to make the most out of all asset classes. And this is a philosophy that we also sort of follow. So we thought that we'll share it with you. Okay. So see, multi-asset works like it suits a wider range of risk profiles. It exceeds the moderate investor's expectation. Now, there's no question here, but I would like to ask you, what is your expectation as an investor when you look at multi-asset as a category or as a strategy, right? You can put in your answers here. What is your expectation when it comes to returns when you hear multi-asset the first time, or you say no, or somebody suggests you, why don't you do a multi-asset strategy? What number comes in your mind when you hear the word multi-asset? So I think that you can put it in the chat box. There's a comment saying 20%. Okay, there's 18, there's 15, there's 12 to 13, there's 10 to 11, there's 11% post fees in any asset class. Okay, beating inflation. Okay. This is a very good question. How different is ithought multi-asset fund since there are 3 to 4? That we'll address once the presentation gets over. But that's a very good question. Yeah, ICICI multi-asset has a track record of 21 years old. Yes. Close to index return. Okay. So if it's close to index return means your multi-asset is beating the index. Because the index is because you're taking much lesser risk than the index, which means you're beating the index on a risk to return basis, which means you've beaten the index. 15. Okay. So majority are somewhere in the line of 14, 15. So 14 and 15 is your equity expectation. That's what you have over a very long period of time. If you've been on a couple of my webinars, you would know that always at the start, I would show a market cycle slide. At the end, I would show, what should be your return expectations, the Nifty entire chart. So in that 12 to 15 is actually your pure equity, 100% equity sort of expectation. Right. 18 and 20 depends. 18 and 20 is your best year unless and until you have a flexible dynamic asset allocation mandate where you're 100% in equity. Right? So then you're not true to label also. But if your mandate says so, then yes, you're true to label. Right. So how do you make multi-asset or how do you make asset allocation work for you, right? So what do we do is that one, we are very conscious on valuations. We don't like to overpay for any particular business that we like. Even if we like the business, we don't like to overpay for it. That's why opportunities for us keep changing. That's why opportunities for us, they come in like a bulk, right? Because we've been holding on of investing in those businesses and taking stakes for you. We are very conscious in terms of valuation, right? The most important thing is that we stay away from the crowd. Right? You should also stay away from the crowd. We also stay away from the crowd. Now, staying away from the crowd doesn't mean that whatever the crowd does, we will do completely opposite of it. No. Uh, yeah, there are so for example, right now, when you saw the chart, you saw a lot of investors going into small caps because of the performance, right? So last year alone, 40,000 odd crores has gone into small caps. This month, maybe in the March month, you would see there might be a net outflow because of the stress test. And the stress test actually gave out very good information saying that if you liquidate the entire portfolio, it will take you more than a month, right? So this is where staying away from the crowd works for you, because if everybody is going in to one particular category or to one particular asset class, then you know that that particular asset class or that particular category is overblown and it's done, right? Whereas you start getting opportunities on other parts of the market, on other categories of the market, on other asset classes of the market, as one particular asset class starts getting overweighted. Like I said, today the opportunity is more on precious metals and on the debt side, right? So staying away from the crowd works for you because you're early, right? And good things come to those who wait. Because you're early, naturally you have to have a slightly longer gestation period, not very long. We have seen in themes where we are very early. For investors, it takes about probably 8 to 12 months more than what our estimated time horizon is for investors, right? So be patient. If you're being contrarian, and be patient and be very, very conscious in terms of what you're paying, right? A little bit of everything works. It's true that a little bit of everything works because you need to be in the mindset, and Sphere is in that mindset of, yes, when we want to grow that particular portfolio, we also want to sustain growth as well as preserve it, right? Our entire philosophy is to grow it and then preserve it, right? That's why we are having this flexible mandate of making sure that, yes, if one asset class works for us, we need a good amount of safety in the portfolio that helps us sustain growth for you as well as preserve it, because Sphere is a product that is meant for retirement, and retirement, of course, is 20-30 years from now for many investors that we work with. And because everything is cyclical in nature, we are able to take advantage of asset classes that offer us stable, reliable yields that we can use again for equity. So 1-2 years of slowdown is not going to impact long-term compounding of somewhere around 12 and 15%, like you said. It's not going to impact any sort of compounding if you be a little rational, if you be a little sane for at least a year and a half or so. You're not going to miss out on any opportunity. So that's why a little bit of everything works. So over a long period of time, that entire case of asset allocation works extremely well. Okay, so sphere is where the magic happens. Now, I think we can take that question of how different is the ithought multi-asset PMS. Just in terms of how other multi-asset PMSs work, uh, they have a fixed mandate. They need to have a certain percentage of equity. They need to have a certain percentage of debt, and they need to have a certain percentage of other asset classes, right? Which means that in any given market, be it a bad market or be it a good market, right? Be it a bull market or a bad market, right? They have to have certain fixed percentage, let's say of 40 to 45% or 60% in some funds in equity. Sphere does not have that restriction. There is no restriction for sphere where it says that you need to have a fixed percentage in this particular asset class, right? So we can go from 0 to 100, like I said, in any asset class. In equity, we can do domestic equity, global equity. In debt, we can do domestic debt, international debt. We can go to precious metals, and we can go to uh, uh, any other asset class as well, right? Precious metals or debt, or we can go 0 to 100 in anything, right? Now, there are allocation limits, right? Then it's a lot more tax efficient. There are a lot more vanilla ideas that's there, right? But for us, it's more to do with flexibility. For us, it's more to do with out of the box thinking, right? So your portfolio is going to be the same as somebody who bought another same NAV uh, for that one multi-asset fund. But Sphere is not going to be that. Sphere portfolios are built completely different. If you pick out any investor's portfolio for us, last 6 months or 8 months, somebody who started since inception, their portfolio is completely different from what we are currently doing, right? And it's all based on your risk appetite. It's all going to be based on your risk profile, right? So there you get pure vanilla ideas. There you get just one particular portfolio. There you just get an app. Here you're actually getting a portfolio that is built for you, built specifically for you, built specifically for your risk profile, and built specifically for your goals alone. Right? Let's say you have a goal after 5 years. Our portfolio will be built according to that only. Right. So you would not, it's not one size fit all. It's your shirt will fit only you. Right. So we create portfolios in such a way that it's all meant for you and it'll work only for you. And we have processes and teams that work for each and every single portfolio. Right. So me and Samyukta spend a lot of time to understand that yes, this particular portfolio has to be built in this way, and one-on-one conversations take place with you in terms of how we are trying to build the portfolio and what you need to do to achieve that particular goal for this portfolio, right? So that's how different we are in terms of multi-asset versus that of a PMS, right? And the fees also is as similar to that of a direct mutual fund, right? It's about 1.5% with no exit load. So that works for you because we don't want investors to be stuck with us. There is no exit load, and it's as comparative that to a direct mutual fund. So this is what the performance has been in the last 2 years. We have been able to outperform pure 100% equity funds. And second, we have been also able to outperform multi-asset funds, but do not see us from a 2-year horizon. This is data that we give out because a lot of investors do ask us, they are very pegged to returns. Do not see these 2-year returns, do not see these high returns. You have to judge us only from a 5 to 7 year perspective. Over a 5 to 7 perspective, we our goal is to deliver 5 to 7 basis points more than inflation. So if inflation is 6%, our goal is to grow more than 5 or 7%. If inflation is 4 to 5%, again our goal is to grow more than inflation at 5 to 7%. Right? That's a very moderate expectation that we have kept. That's a very, very moderate expectation that we have kept, right? But over the last 2 years, we have done extremely well in terms of performance. Since we have that flexibility to go overweight on any asset class, and we've been overweight on equity as an asset class and precious metals as an asset class, right? So the drawdowns since inception, that is over the last 3 years also have been very good. Nifty has had a drawdown of 16% and multi-asset has had a drawdown of 8%. These are multi-asset funds. And Sphere has had a drawdown of 11%. This is again our split up. So 81% of our assets right now, overall asset class. This has nothing to do with individual portfolios that we're building, but these are overall asset classes. Uh, the overall asset class allocation is 81% in equity, 9% in precious metals. We have a very small amount of it in cash. Debt is 2% and global is 7% of the portfolio. Right. This is an overall picture, but portfolios that we were building over the last quarter have higher allocation towards precious metals and debt, and lesser allocation towards equity. Far lesser allocation towards equity, if I may. So the minimum investment is 50 lakhs. As per SEBI's guidance, as per the regulation, 50 lakhs is the minimum amount. Our benchmark is NSE multi-asset index, and the fees is fixed. There's no profit sharing. There's nothing. It's 1.5% per annum. And this is suitable for anybody who has a 5 to 7 year sort of horizon. So this is the whole team. If you can see, me and Samyuktha are also there in one part of strategy. And we work closely with the research team. So it's a synergy that happens. And we work closely with the research team and fund managers of other funds as well. You would know that Rajat and Rohit also are they are managing the small cap fund, and good interaction takes place with them when we want to build a small cap portfolio. At the same time, Balaji sir, who's our head of research, we work closely with him also. So the entire team works closely with the research team. It's a very, very big synergy, and all of this is headed by Sham sir. Okay, so I think now we can open the floor for Q&A. So there's one question that has come in. As your data shows that your sphere delivers double than the index, means the risk is also double. No, because since inception, our beta has been somewhere around 0.64, but that was in December. That we were able to do because the businesses that we were buying on the equity side were not volatile businesses. It was majorly large caps. And these were all stable businesses, uh, but very high quality businesses, right? And on top of that, when we had exposure towards precious metals and towards slightly on the debt side, our risk was far lower than that of the index. And we don't deploy money on day one. 100% of the money does not go in on day one unless and until we get a June 23, June 22 sort of scenario. Sorry, June 22 sort of scenario where everything is extremely cheaply available to us. Right. So it takes us good amount of time for us to invest that money, invest that entire 50 lakhs that come to us. And that's how we are spreading risk. And that comes into the data. Second metric for risk is that the drawdowns have been lower. So if we had that of higher risk than the Nifty index or any sort of index for that matter, Nifty 500, then our drawdowns would be significantly higher when the market turns. But that's not happened. So we've been able to protect our investors very well. In fact, us staying at the sidelines has helped us every single time when we've seen bad scenario or a bad day or bad week, where we are able to capitalize on the businesses that we want to buy, because high quality businesses don't come to you at very cheap valuations, right? So we want to be conscious about those valuations. So we are able to capitalize on it when we get that opportunity. So risk management comes out on top for us, and the risk, whatever risk metrics that we've been checking is very low.
All right, so I'm just going to take one of the questions that came earlier in the chat, which is, as an investor, why should I invest in Sphere rather than increasing my portfolio in Solitaire? Now, I think the way that we look at the ecosystem is that we are not actually trying to pit one product within the ithought PMS ecosystem against another, right? It's not a Solitaire versus Sphere or a Vriddhi versus Solitaire or a Vriddhi versus Sphere or a True Blue versus Sphere. That's not how we look at it. We actually think these portfolios work in a very complementary manner for the investor. There will be phases where solitaire will perform. There will be opportunities that are there in multi-asset at certain points in the market. So this, I think, is more of a personal question that you would need to address, right? Why have you made the investment in Sphere? Why have you made the investment in solitaire? What goal is it working towards? And is this the right time to contribute to one of these or both of them? So we have a variety of investors who have investments across different PMS schemes within ithought itself. And we found a very nice way to balance that investment and say that, okay, this is our plan for the year. This is how much we're going to look at contributing here. This is how much we're going to look at contributing there. And then kind of fine tuning that as the market also changes. Right? This is our approach, and we think it works very well because investors have seen success in both, or rather, all products within the ecosystem. Okay, so the question after that is, why does multi-asset chase returns, and where is the safety uh, from downside protection? We try not to chase returns, right? That's our whole philosophy. We don't want to chase returns. We would rather test an investor's patience than their risk appetite. That's our core philosophy. I would rather have an investor say that, okay, I'll wait one more year, right? Because I'm being safe, than to put them in something where I've got performance and I can show them that, oh, last 3 months, 6 months, 1 year return in this asset has been great. I think we should fully participate there. I would not want to take that kind of risk. We come with a 5 to 7 year horizon because patient investing has led to the best results for us as a house. That's every fund manager in our ithought ecosystem believes the same thing. This is how we've seen wealth creation happen since many years, right? So whatever we have learned is that, okay, it's okay to go a little slow, it's okay to be a little bit early, but it's not okay to chase performance. And that actually gives us the downside protection.
And to add to that also, because we are in the investment committee and when we discuss ideas, I think the first thing that we want to address is it's not how much can we make of this, is how much we can lose of this. Right? If the number for how much we can lose here is higher, then that idea does not go through itself. That's the first screening process that happens. It does not go through, and only then we try to take that call of, okay, what is it that we need to do in this particular portfolio for Sphere in general.
Right. So I'll go on to the next question, which is, what is our minimum investment? Would you invest through MF multi-asset funds of various houses? No. So I think, see, if we are going to do that for the investor, where I go and buy someone else's multi-asset fund, then I'm really not doing justice to you as a portfolio manager, right? That is something that you can do. What we do, of course, we do own some mutual funds in Sphere as a portfolio, but those are very selective. We look at where the opportunity is. If I have a thematic or a broad-based uh, idea, and I see that one fund manager is able to address that in a very effective manner, then I will have that mutual fund in my portfolio. Similarly, for certain, you might even have certain ETFs on the global side. You might So, for example, one of the things that we noticed is that the best way to play debt is through the mutual fund route because it addresses this liquidity thing. It addresses the diversification requirement also when you're looking at debt. So, all of this gives us an opportunity to look at mutual funds, but I'm definitely not buying another multi-asset scheme within the Sphere portfolio because that is, I mean, we have more flexibility than the multi-asset funds in the sense that we can go 0 to 100, right? So if I have a high conviction idea within my universe, then I will just allocate there. Okay. So as your data shows, your Sphere delivers double than index, which means risk is also double. Is it not so? And why would we take more risk? Because if the fall happens, it will be a big fall too.
So I addressed that question because I think that popped out the last.
Correct. So also, I think just to add to that, there was this really interesting quote from Howard Marks where he says that if you think that high risk investing gives you high returns, then high risk assets are a very reliable way to consistently get high returns, right? Uh, and that means everyone could invest in high risk assets and everyone could make a lot of money. But and that's obviously not true because people who go into high risk assets are not always making money, right? Which means that there is something else to this nature of high risk. It's not just high returns. It means that there can be wider ranges of returns, and we want to minimize risk. And that means it's also true of low risk assets, right? And that's our core philosophy. If this is true of high risk assets, it's also true of low risk assets. And there can be a way to take lower risk and make better returns. It's not easy, but the concept is simple, right? And it requires work, and that is something that we have done. So, like Harshil was saying, if you look at some standard metrics like our beta and our drawdown, yes, we are like in terms of drawdown, we are below the multi-asset index or the multi-asset funds, right? But that's also because you're taking a longer investment horizon. We are not looking at quarter on quarter performance. We're not looking at month on month performance. We've told you also very clearly that, yeah, we have 2 years of performance data, but wait for a few more years. If you really want to judge us and see whether we're doing the right thing, you need to give us more time before you can see that. Harshil, you want to take this? How are multi-asset funds different from balanced advantage or dynamic asset allocation?
It's all in the mandate. If they're so for a balanced advantage fund, their mandate would be, somewhere around 70 to 18%. Dynamic asset allocation again would be different. That they would have specific rules in which you go out and invest in. So more or less the category is the same. It doesn't matter whether you do a BAF, whether you do dynamic, whether you do multi-asset. The category entirely is the same. And can you have both in your portfolio? No, one fund is enough. See, if you're having the same thing in the same category, then it does not make sense unless and until there's a entirely different strategy playing out. Like for equity, you have flexi-cap as a strategy, and you have flexi-cap as a category and many flexi-cap funds. Right? But each flexi-cap fund works in a different style. Each fund manager has a different methodology. And I would suggest you to read the methodology first, right? Whether they are following a growth or whether they're following a value. And my suggestion is if it's a complement of both, if the one fund is complementary of the other fund, then it makes sense for you to have. Overall, your return expectations would somewhere be around 9 to 12% if you're doing this sort of strategy. On the mutual fund side, 9 to 12% should be your expectation when you're doing this sort of a strategy. Is the strategy churn more? Does this strategy churn more frequently? No, our churn turnover ratio is somewhere around 30%. So this is since inception. This is not 1 year. Since inception, this is 3 years. So not a lot of churn. Sam, do you want to take this? How do you invest in
Yeah,
long-term debt under Sphere? So I think,
I
and
think
what
for
is the
us, the
percentage?
preferred route is through mutual funds. And in terms of what our percentage allocation for debt is, see, I mean, today we are comfortable with it. It can go higher also depending on how hot the equity market gets. So I don't have a fixed number in mind. It is more dynamically managed. Like we do review and we look at how the market is, where the opportunities are, what the pricing is. Let's say your rate cuts are delayed by another 6 months, obviously my allocation will go up, right? There are so many moving parts that I might need to look at before I put a number to that. But I think, like Harshil said, we have that flexibility to go to 0 to 100. I don't think you're really going to ever get to 100% in debt because today, if we look, the multi-asset opportunities are so great. Like equity is performing, gold, your precious metal basket is performing, your arbitrage basket is performing, your fixed income basket is performing. So today I'm really spoiled for choice. Like it's tough to say, okay, I can't even say I'll do 25, 25, 25, right? Or split it evenly across all four. Like day to day, if the price is changing, then what do? I can't take a call. Tier is
Uh,
for retirement
yeah.
after 15 years. What about retired people?
See, for retired, I think that the mandate is that you need a payout. And if you need a payout, then you need to grow somewhere around 9 to 10%, so that you can take out 7% or 8%, whatever. See, it depends on your mandate. Like if you need to take out 8% per annum or 12% per annum, then we will have to build assets accordingly. But then Sphere would not be that particular product for you. Uh, but we do have options on the mutual fund side where we can have a plan for you. We have a planning team in house that can help you out in seeing, okay, this is what you have right now, and for you to meet your expenses, you need to grow also by this much, and for how long you can sustain, living off that particular capital that you have if you grow at various levels or various rates. So you can just send us a hi on this number, or just send us what your requirement is on this number, and our planning team will definitely be able to get in touch with you, right? And then we can plan as to how much you would require after now, while you're in retirement, given the capital that you have, and how long you can sustain for. Next question is, do you have skin in the game?
I think, I mean, to just give you a sense, right? The people in our team have been here for a long time. So I've personally been at iThought for more than 8 years this month. Harshil, I think, is six, right? And
Sixth,
there's
sixth
no
year.
intention of really changing that. So I don't understand this question. We are very committed. We are very passionate. We want to do this. We have been doing this for a long time, and our learning curve has been so good, right? At every point, we've been able to innovate and do better for the investor. So there is no other place that we would really want to be.
But skin in the game, does it mean that are we investing in the fund? Are we taking aggressive calls uh, for ourselves? It's very open-ended. If you ask us, do we have skin in the game? Because I think the game for us is completely different. The game for you might be completely different. So I mean, I don't know if it has a lot to do with us being investors in the fund. But if that's the case, then the head of investment strategy, Niranjan sir, is an investor in the fund, and we do take care of his money as well. Yeah, skin in the game is there in the team, definitely. But if you have any follow up on that, we'll definitely be very happy to address it. But by basic, but basic is by name of the name multi-asset itself is bound to have lower returns. That's why I asked you what is your expectation of low returns, and all participants had to comment 18, 20, 12 to 15, 9 to 11, or 11, right? No, I think last 3 years has disrupted the entire expectation game. That everybody is expecting, if I put money in the market, means I'm going to get somewhere around 20% or 25% return. That's not the case. Multi-asset only means that we can take advantage of other asset classes. It has nothing to do with returns. In the industry over the last 13, 14 years, because they are having this sort of a mandate of fixed mandate, they've been able to deliver the sort of return. But we have been doing this sort of model for the last 10 years since inception, and that model has played out very, very well for us on our RI firms, right? That was the same model that we were doing, and their aggression was quite high, right? So over a long period of time, having a multi-asset approach, we had been able to do somewhere around 15.5 to 16%, right? That was over 10 years compounded, right? So it has nothing to do with it generating you high returns. It has everything to do with the mandate and what the mandate allows the fund to do. Right. Mutual fund, multi-asset funds are not allowed to take more risk than what they are meant to, because it is a retail product. It is meant for people who are saving money. The saver matters a lot, and if the saver does not have the patience, does not have the appetite, then the fund should not take risk, right? And they have done extremely well for that category by making sure that they don't take risk for investors, right? And in that, they have been able to generate on a long-term basis somewhere around 9 to 12%. It's fantastic because index itself is able to do 9 to 12% over a long period of time. They've done a fantastic job, right? So the strategy can give you, it all depends on the mandate, right, and how you view that particular mandate to be. So don't categorize it as, okay, this category is supposed to give you low, small cap is supposed to give you high, so you should always have 35, 40% sort of expectation on small cap. It all has to do everything with the strategy and how the fund management team is deploying money and how they're managing capital.
So I'll
Do we?
take the next
Yeah.
couple of questions, which is, do we deploy all the capital at the same time? No, we're very conscious about valuations, right? That is one of the core things that we do because that's what enhances performance. If I overpay for a company, your return is going to reduce. So typically you will not see, like if you give us money, you will not see it fully deployed in 1 month or even one day. It takes a few months depending on where we are in the market and what the opportunities are. But this allows people to participate continuously, right? So typically, if you see how we've grown the Sphere ecosystem itself, we had investors who came in with very little capital to start with and saved over a period of 5, 10 years. And then they got to the PMS size. And then they came into the PMS ecosystem. So they were still in that habit of saving monthly, right? And you'll see that. So now they have this, that habit hasn't discontinued. They're able to use this as a saving vehicle. So we don't deploy all the money on day one. We take our time to do that. At the same time, we want to do it in a manner that encourages people to continue to save. Right? This is, we look at this as a saving solution, not as a PMS. Like, generally how the industry looks at a PMS is, okay, you put the 50 lakhs, you forget about it. That's your investment. That's not how we see it. So since there is no mandate and Sphere, is this product better than the other products? Um, Actually, see, we don't like to think of one as better than the other, right? Other people seem to have that mentality that based on ideally performance, they will come and tell us that no, no, I want to open an account in this scheme or I want to do this. But we don't look at it that way. I think we look at the product investors fit, right? Is this investment solution going to work for you, right? If you are by nature a very aggressive person when it comes to your investments, you might want to look at true vriddhi even in this market, right? Because that style is going to suit you. Forget the next 2 months, 3 months, whatever, this year. Even if you discount this year, if that's the product that's right for you, that's where you need to be. Similarly, if you're the kind of person who wants a more, like, smooth journey year on year, you want to be able to do this all the time, not really look at too many ups and downs, then I think Sphere is better for you. It's not at the product level that one is superior to the other. The way we've positioned each of these also is that they work for very different kinds of investors and different kinds of investment needs. They are proper solutions. So you can pick and choose and combine as to what suits you and how you want to look at your investment journey, because for us this is a long term thing. We want to do this with you for the next 10, 15, 20 years, and being in the right product is actually going to help you stick around for longer.
See, for example, if you're you can take high risk, then Vriddhi and Sphere works for you because Sphere works as an anchor, right? Likewise, if you're a moderately aggressive investor, then Solitaire and Sphere works for you because again, Sphere works as an anchor, right? If you're a moderately conservative investor, then True Blue and Sphere works for you because then for you, True Blue becomes the driver of return. For Sphere becomes the driver of return, True Blue becomes the anchor. If you're a completely conservative investor where you don't want to take any risk, then True Blue works for you very fine. It's a 100% pure quality large cap portfolio. So if you're an extremely risky investor that you don't mind seeing, having a 20, 25 plus year, then Vriddhi works for you. So we've we like to keep it as a basket because each and every product in our ecosystem is a complement to the other.
Yeah. So under Sphere, yes, we do invest in global funds as well as ETFs, global ETFs. I think this question has been answered in terms of skin in the game. Yes, there are assets within the management team itself, within Sphere, as well as all the other products. We have employees, everyone contributing to that. My investment in fixed income covers my retirement. So Sphere, I'm not going to withdraw any money. Is it better for me to invest in Sphere? Yes, absolutely. If you're retired and you want your wealth to grow, this is a great product because it gives you that flexibility to uh, be in the product. It gives you that flexibility to add. Let's say you have a little bit extra rental income, or you don't spend the money that you've been getting from your fixed income assets. You can put that back into Sphere. At the same time, let's say you have some requirement to take out money also, as long as it's meeting that regulatory threshold, uh, And I think you'll have that flexibility there as well. But it's not suitable for like regular monthly outflows, right? So beating inflation or around 10% is a normal expectation as per index CAGR for multi-asset as well. So only uh, double, how can you give yours 2021 means takes high risk, right? No, sir, I think we've answered this question. We've not really taken high risk. And you can look at metrics, you can see that you just need to understand that our philosophy is very different. Like if I'm buying cheap, I am going to make higher returns than somebody who's buying expensive, right? And if you compare to the index is always buying expensive because what goes in is what has risen in price. What comes out is what is not performing. So essentially, your index is always going to give you a slightly below average return because of this mechanism in which it is rebalanced, right? That's not what we're doing. If something is cheap, we're going to buy it. So I'm making my little bit of extra return there. I'm not making my little bit of extra return by taking a high risk investment. Thank you,
So
everyone. I think,
there's a last question on, in a way, can I consider Sphere as an alternate to my NRI FD? Yes, you can. So we have
yeah.
a separate product for NRIs called Neo. And we will do Neo webinars as well. It's the same team that manages Neo as well. So you're very familiar with the process. You're very familiar with the people. Nobody new. Neo is that option that again follows the same flexible mandate, but because the needs for NRIs are completely different, so it's constructed for them in that particular manner. Is there a current split of asset allocation in Sphere? So we don't give out. So current allocation, we shared it along with the performance sheet, but we have not started to share, 3 month or 2 quarter or half yearly portfolios that we are building. That would become too much data for you. That would become too much information in terms of what we are doing. But one-on-one client level works extremely well in terms of where their assets are going, because everybody has a different need. Right now, equity is somewhere around 81% on an overall basis. But newer portfolios that are getting built, there the equity allocation is somewhere around 35 to 40%. Right. Gold and precious metals, that is precious metals as a basket, is not gold alone. Precious metals as a basket is a higher allocation. It's somewhere around 8 to 12% that we have built.
I think
And
even more than that, Harshil. I
more
think
than
we
that, yeah.
probably have more than that.
Hmm.
And then
And
debt, of course, is higher. So, like Harshil was saying, if we see scheme level, it will show you 80% because one of the things that we do is we mentioned that we're tax conscious, right? We don't just shift out of performing asset classes because they have performed. We have to have a valuation based reason to exit. So older portfolios, and of course, a majority of our clients have come, uh, say in 2022, tend to have like a larger equity allocation primarily because over time those equity ideas have performed and we've just not exited them, right? So overall, you'll see 80% on the scheme level, but individual accounts, like Harshil said, is right now there's a heavier allocation towards all the alternate assets.
does asset allocation differ for each person? Mandate is different. Mandates will continue to be different for each individual. So we are curating them for them based on that particular mandate.
Okay, so I just want to clarify this in terms of whether asset allocation differs for each person. Now, automatically that will happen primarily because the markets itself moves, right? But if you're saying that can I tailor make something for you within Sphere, that doesn't happen. That happens through your participation. So depending on when you contribute, and what asset is attractively priced, that's how your asset allocation varies. That in combination with performance. But overall, let's say all investors who come in this month will ideally have almost identical asset allocations. But the drift happens because of their individual participation and the opportunities that are available at specific points in time. We can do that on the mutual fund side. We cannot do that on the PMS side. If
Yeah.
you come in saying that you want this allocation, we can create that for you on the mutual fund side, but we can't do it in the PMS.
Yeah, it's a
We have
completely
to do what we're
discretionary
doing for
PMS.
all clients
Yeah,
at the same time.
it's a completely discretionary PMS.
So if you would like a PMS to do it for you, I think you can look at, say, a non-discretionary multi-asset PMS. Then you can kind of dictate what is the asset allocation, what are the assets, and they should be able to customize it for you at that level. But a sphere is, like Harshil mentioned, a discretionary PMS, which means the discretion lies with the fund manager, and we will decide what is a suitable allocation for one point in time. So I think we can do like a chat probably with you and discuss how we can look at a low risk investment solution. And you test that out with us for 1 or 2 years. You can start small, see if you're comfortable with the way we're managing it, and then uh, take a call as to whether you want to scale up or how you'd like to take the next steps. Because we've worked with a lot of very conservative investors, we work with a lot of people who've never invested in the equity markets only. And we've managed their investment journey from taking them to from pure FD investors to being at least moderately okay with a certain level of risk in equity investments.
I think now we can close. We are not getting any other
Further
questions.
questions? Okay. Thank you everyone for being here with us today. It means a lot for having these kind of conversations, addressing questions, and then sort of being able to keep an open conversation about multi-asset investing. I hope today's conversation leaves you with a winning solution across market cycles. Do get in touch with us if you need anything else. Um,
50
and
lakhs
thanks
is
once again.
minimum for Sphere. Yes, I think that's the last question. 50 lakhs is minimum for any PMS, not alone for Sphere.
Yeah, that's a SEBI
At one time.
requirement. It's not our.
You can transfer whenever you have the funds or whatever your bank limit is, but we can only start working on the money after we receive the entire 50 lakhs. I think that's it. I think thank you all for joining in. Have a great weekend ahead.